Most people think DGRO and DGRW are the same ETF with a slightly different haircut. And that tiny assumption can quietly cost you years of compounding, or at least a whole lot of sleep. In the next 10 minutes, I'm going to show you the real difference that actually changes what you own, what you earn, and what you pay for it. If you're building a long-term portfolio in your 20s, 30s, 40s, 50s, or basically any age where you still enjoy electricity, this matters. Because dividend growth is supposed to be the boring part that works, but if you pick the fund that does not match your goal, you can end up with the wrong kind of growth, the wrong kind of dividend, and the wrong kind of expectations. Which is a polite way of saying you may accidentally volunteer to work longer. Here's the plan. I'll explain what DGRO is actually designed to do and what it screens for. I'll explain what DGRW is actually designed to do and what it screens for. Then we'll run a simple, real-world scenario so you can see why they feel similar but behave different. Finally, I'll give you a clean rule of thumb to choose the right one for your portfolio. Disclaimer. This content is for educational and entertainment purposes only and is not financial, legal, or tax advice. Investing involves risk, including loss of principal. Consider your goals, time horizon, and risk tolerance before investing. Speak with a certified financial advisor to help you develop a customized plan. Now, let's get back to learning. Let's make this painfully simple. On the surface, DGRO and DGRW look like twins who shop at the same store. DGRO is iShares Dividend Growth Fund. It targets U.S. stocks with a history of consistently growing dividends. It is cheap at 0.08% expense ratio, and its published yields have been around approximately 2.1% recently. DGRW is WisdomTree's Quality Dividend Growth Fund. It uses quality and growth screens, charges 0.28%, and has shown a lower published distribution yield in the neighborhood of approximately 1% recently. Portfolio size. DGRO has roughly approximately 395 holdings, while DGRW is more concentrated around approximately 200 holdings. Dividend schedule. DGRO typically pays quarterly. DGRW typically pays monthly. So what's the real difference? The difference is the recipe. DGRO is more like, show me companies that have proven they can raise dividends and make sure the dividend is not a desperate cry for help. DGRW is more like, show me companies with strong quality and growth characteristics. Then let's focus on the dividend payers within that group. Those rules change what gets in, how much each company weighs, and how bumpy the ride can feel. But here's where most people get this wrong. They compare only the dividend yield, or they say, monthly dividends feel better, so it must be better. That is like choosing a gym membership based on the font on the sign. The next part is the real unlock, because we're going to talk about what you are actually paying for and what you are actually concentrating into. Deep Dive Part 1. What each fund is screening for. DGRO's vibe. Prove you can grow dividends. The index behind DGRO screens for things like a multi-year history of uninterrupted annual dividend growth and a forward payout ratio under about 75%. Plus, it avoids the ultra-high yielders that can be dividend traps. Translation? It's trying to find dividend growth that is sustainable, not dramatic. DGRW's vibe. Prove you are high quality, then pay dividends. WisdomTree's approach emphasizes quality and growth characteristics, using a rules-based composite of factors. Translation? You can end up owning more of the mega-cap, high-profitability crowd, and the portfolio can be more concentrated. Deep Dive Part 2. The fee math nobody feels today, but everyone pays later. Quick math, no scary spreadsheets. Let's say you invest $100,000 for 20 years and the market gives you 8% per year before fees. If Fund A costs 0.08% and Fund B costs 0.28%, That's a 0.20% gap. That's nothing, your brain says. Your future self says, that was my vacation budget. Using a simple fee drag approximation, 8% minus 0.08% is 7.92% net, and 8% minus 0.28% is 7.72% net. Over 20 years, that difference can be roughly $8,000 to $10,000 on $100,000. And that's before we talk about taxes, behavior, or the fact that you might add more money over time, which can magnify the gap. For your convenience, I posted the performance metrics on screen. What should you notice here? 5-year returns favored DGRW, 75.53% versus 62.50%, which fits the idea that a quality and growth tilt can juice performance when big quality names are running. But in the last bull run, DGRO actually edged it, 24.90% versus 21.11%. And in the last bear market, they were both relatively resilient, with DGRW slightly less negative, minus 9.35% versus minus 10.38%. Translation: neither one is a magic shield, but both aim to be sturdier than the overall market, and their different recipes can swap the winner depending on the season. Also, the beta difference matters for real life. DGRO at 0.72 is basically saying, I do not want problems. DGRW at 0.85 is saying, I can handle a little spice. Pick the one that lets you stay invested, because the best return is the one you actually stick around to earn. Deep Dive, Part 3. Monthly dividends are not a cheat code. DGRW paying monthly can feel like you unlocked passive income mode. I get it. It is like getting paid every 2 weeks instead of monthly. Same salary, different vibes. The schedule does not magically create more money. A fund can pay monthly, quarterly, or whenever it feels spiritually aligned. What matters is the underlying company's cash flows and the fund's total return after fees and taxes. So do not pick a fund just because it texts you more often. Deep Dive Part 4. Concentration, aka, why does my dividend ETF look like a tech ETF? DGRO is broad. Think hundreds of holdings, more like a whole garden of dividend growers. DGRW is more concentrated. Think a carefully curated salad, where the top ingredients can take up a huge part of the bowl. For example, DGRW has been reported with approximately 198 holdings, and a single company like NVIDIA has shown up as a very large position, around the high single digits at times. DGRO, on the other hand, tends to spread things out across approximately 395 holdings. That means DGRW can hit harder when its biggest names are on fire, and it can also feel more dramatic when they are not. Deep Dive, Part 5. The real difference nobody talks about. Here it is. DGRO is a dividend growth discipline fund. It starts with dividend behavior and sustainability screens, then builds a broad portfolio. DGRW is a quality and growth factor fund that also pays dividends. It starts with quality and growth characteristics, and you may end up with a portfolio that leans harder into today's mega cap winners. And this matters because the biggest investing losses are not always from bad funds. They are from good funds used the wrong way. If you buy DGRW for income and then panic when it behaves like a concentrated growth-leaning portfolio, you might sell at the worst time. If you buy DGRO expecting it to keep up with the hottest growth trade every year, you might get impatient and churn your plan to death. Your portfolio does not need more drama. Your Netflix already provides that. Now here's the part nobody talks about, and it's why people lose money without realizing it. They compare the wrong numbers, and then they put the fund in the wrong job. One site shows distribution yield, another shows SEC yield, and suddenly you think one fund is paying you double. Meanwhile, the bigger issue is, are you building a steady dividend growth core, or are you paying extra for a quality growth tilt that might outperform or might just feel spicy?
Here's the fix. 3 questions. No overthinking, no vibe-based investing. 1. Do I want a low-cost, broadly diversified dividend growth core? If yes, DGRO is usually closer to that job description because it is built to be broad and cheap. 2. Do I specifically want a quality and growth tilt inside dividend payers? If yes, DGRW can make sense if you accept higher fees and more concentration, because that is literally what you are buying. 3. What will keep me consistent? The best ETF is the one you can hold through boring years and ugly years. Pick the one whose behavior you can tolerate, then automate contributions and stop touching it like it is a hot stove. Rule of thumb: if you want set it and forget it dividend growth, lean DGRO. If you want dividend growth plus a quality growth filter, and you understand it may look more like a concentrated mega-cap portfolio, consider DGRW. 1-minute action checklist. Look at the expense ratio. Fees are guaranteed. Returns are not. Check how many holdings the fund has and how much the top 10 make up. Concentration changes the ride. Glance at sector weights. If you hate tech swings, do not accidentally marry a tech-heavy portfolio. Write one sentence: I own this fund because. If you cannot finish that sentence, do not buy it yet. And here's the motivational part. You do not need the perfect fund. You need a clear plan and the courage to be consistent when it is boring. Dividend growth is not supposed to be exciting. It is supposed to be effective. Pick the strategy you understand, keep adding, reinvest if it fits your plan, and let time do the heavy lifting while you go live your life. The takeaway, aka the quick recap. You should now know that DGRO and DGRW are not the same dividend growth ETF. DGRO is built to be a low-cost, broad dividend growth core. DGRW is built around quality and growth screens, with more concentration and a different feel. You also learned that dividend frequency is not free money. Fees quietly compound, and the right choice is the one that matches your goal and keeps you consistent. If this video helped you, do me a favor. Hit like, share it with a friend who's into investing, and subscribe for more money truth with less money stress. If you want a step-by-step guide you can actually use, check out my books, The Wealth Basics, A Practical Guide to Investing and Building Generational Wealth, The Stuff We Should Have Learned in High School, and AI Meets Finance, Investing in the Age of Artificial Intelligence. They're available on Amazon, and the links are in the description. Now watch the next video on your screen to keep the wealth building education going. Thanks for your support. I'll see you in the next one.